Yo, what's good, everybody? Welcome back to another section here at the Day Trading Institution. So pretty much what we're going to be going over today is trading terminology. So this is still like the beginner stuff, but we're starting to get out of the beginner section, which is an important section, but it's the most tedious one to learn because we're getting down into like the foundation of what Forex trading actually is. So what we're going to be learning in this lesson is we're going to be pretty much covering what a pip is, what lot sizes are, what the bid price is, what the ask price is, along with what the bid-ask spread is. We're also going to be going over what a quote conversion or convention is, what a transaction cost is, and last but not least, what a cross currency is. So what is a pip? So you're going to hear me refer to a lot of these terms throughout the course. So what a pip is, it's pretty much a unit of measurement used to express a change in value of a currency pair. So when we talk about pips, right, we're really going to be referring to how much a specific currency pair has actually moved. So you may hear me say in one of the videos, hey, gold dropped 50 pips, and that's how we measure the move and determine how big of a move it actually was. So let me kind of go back here before I skip on too much, right? So if you guys could actually see, so I mean, it really depends on the brokers too, but really this is how the normal market is, normal exchange rate. So we pretty much are only moving one decimal over, and that's going to be our pip count. So if we start here, this is going to be 8 pips. So if the market goes from 8 to 10, then we know that's going to be 10 pips, right? But if the market goes from 8 to 10, this is going to reset back to 0, and this will be 4. So this will be 40 pips, right? So anyways, this is going to be 8 pips. This is going to be 30 pips. This is going to be 500 pips. So let's say the market went from 538 to 540. The market's gone up 2 pips, and this will be 500 flat, or this will be 500 flat, right? But we'll get into that a little bit more in detail later on, right? So now let's go over an example of what an actual pip is. So if GBP USD moves from 1.1050 to 1.1051, then the 0.01 USD rise in value is going to be 1 pip. So if price went from 1.1050 to 1.1051, that's going to be a 1 pip difference. So the market went up 1 pip. Now, here's another way to actually understand it. If you notice, most currency pairs go out of a 4 decimal place, right? However, there are some expectations like the JPY or the Japanese yen, in which they only go in 2 decimal places. Now, again, this is going to depend on the broker. Sometimes, well, most brokers are going to offer your pipette is typically what it's called, which is going to be your micro pip. So it'll have 3 decimal places, but really only normally has 2 decimal places, right? So a pipette, exactly what I was just talking about. In simple terms, some brokers might quote currency pairs to the 5th decimal place, which almost all brokers quote currency pairs to the 5th decimal place, as you can see here, right? Now, how do we calculate the value of a pip? So let's take this example. Let's say the exchange rate for USD CAD is going to be 1.0200, right? To be read as $1 to 1.0200 Canadian dollars, or 1 USD for 1.0200 CAD, right? All you simply have to do is divide 1 pip, usually 0.0001, by the current exchange rate pip, which is the pip value in terms of the base currency. Now, I don't want you guys to really kind of, overcomplicate this. I want to break this down for you guys so you guys will always have the formula, and you guys can always go back, reread the slides, rewatch the videos, right? So in simple terms, if we grab the current exchange rate and divide it by 1 pip, right, it'll give us 0.00009804. So if we traded 10,000 units of USD CAD at the current exchange rate being 1.0200, right? Now, if we do 10,000 units times 0.00009804 USD per unit, which is going to cost us 98 cents, right? That's what we're going to be quoted, right? Meaning 1 pip change to the exchange rate would be 98 cents to the dollar. Now, just a quick reminder, just focus on understanding the idea and principle of these terms. Don't try and actually memorize it and overly focus on just overly focusing on the definition. I just want you guys to understand why certain things are they are. But in terms of reading pips and calculating pips, you don't have to do the complicated mathematical equations. Even though I do want to put it on here just so you guys have an understanding on how you can do it and go about it this way. There are going to be a lot of, again, in our programs, which we'll cover in the next section, I'll cover how to use the pip calculator, along with, actually measuring how many pips the market has moved and everything else. There's literally indicators that tell you how many, how much the market has moved and everything. So don't try and just understand everything to the exact definition, but just get the idea and the principle of these terms. Now, what are lots? Lot sizes are pretty much going to quote us on how much money we're actually buying into the market or selling the market. So lots are the number of currency units you will buy or sell. When you place orders on your trading platform, orders are placed in quoted orders are placed in sizes quoted in lots. Now here is a chart, a lot size chart, basically on how much you will make per pip. So when we actually press that buy or sell button, we're going to be entering lots. We're not going to be entering the unit, but we're going to be entering lot sizes. We're going to be entering the volume here, right? So if we look at the volume, these are going to be the lot sizes. These are just the definitions of the lots. But let's take a look at the nano lot. Typically, most brokers don't offer nano lots, so I'm not really going to go over it too much. But what they'll do offer is micro lots. So, depending on what lot size you're going to use is all dependent on your account and how much money you're looking to risk, along with how much money you're looking to make. Obviously, the bigger the lot size you use, the more you're going to be risking, and then the more you're potentially willing to make. Now, when it comes down to micro lots, a micro lot is pretty much where you're buying 1,000 units worth of whatever currency you're looking at. And when you actually place it in your MetaTrader 4, it's going to be a 0.01 lot. So a 0.01 lot translates to about 10 cents per pip. So if the market goes up 10 pips, you've made $1 because you bought in at 10 cents per pip. Same thing with the mini lot. The mini lot, you're actually going to be buying 10,000 units, right? So that is going to be a lot size of 0.10, which means you're going to be making around $1 per pip. So if you buy Euro USD and the market goes up 10 pips, you've successfully just made $10 because you used a 0.10 lot, meaning you're making $1 per pip, right? Now, the standard lot size, pretty much, the lot size you want to throw as a beginner. Well, not want to throw as a beginner, but that's typically like the beginner's goals. I want to do one lots because you can make a pretty decent amount of money using one lots. So with a standard lot size, you're pretty much buying 100,000 units, which is going to be a 1.00 lot, meaning you're making $10 per pip. So if the market goes up 10 pips and you bought Euro USD and the market goes up 10 pips, you've just successfully made $100. Now, obviously, we're going to go over it, in more detail, everything later on, the actual chart, how you can actually make money. But this is the things that you need to learn. And little by little, just take it little by little, as time goes on and you actually start trading more and more, you'll start getting the concepts better. Again, everything in trading is all based off of experience. You may not understand, how lot sizes work and everything at first, but, as you play around with a demo account and you start to learn things, everything is experience. You'll get the hang of it. I promise you that. So don't get overwhelmed, especially not in the beginning section, right? Now, let's look at an example here. Let's assume we will be using a 100,000 unit standard lot size, meaning we're using a one lot, right? And also one thing before I continue, right? There's 10 lots, 50 lots, 60 lots, 70 lots. Remember, one lot is $10 per pip. So if I'm doing 10 lots or 1,000,000 units, right, then I'm making $100 per pip. So if the market moves up 100 pips, right, I just made $10,000, right? So again, there's, 0.01 lots all the way up to, 1,000 lot, 2,000 lot. Again, it depends how much money you have in your account and everything else. You can do 500 lots, 600 lots, where you're risking, $6,000 per pip. it's all about levels and slowly looking to level up. You're not going to be able to do 10 lots, right off the bat on your first trading account. More than likely, you're going to blow the account. And just remember, right, when you enter, let's just say 10 lots, right, and you have a $10,000 account or whatever the case might be, even though 10 lots for a $10,000 account is a lot, right, you're probably going to have to go through the experience of, losing a lot of money very quickly so you can overcome that psychological barrier. So as there's levels in trading, you're going to have a lot of psychological barriers that you're going to have to overcome. And if you're somebody like me, where I tell you, hey, don't enter 10 lots on a $1,000 account, but you're like, whatever, I'm going to do it anyways because I'm probably right on this trade, and you blow your account, and you have to experience the pain to not do that mistake again, then you're probably going to lose quite a few in the beginning. But just keep in mind, like, the emotions when you actually place that trade. When you see that you place your first lot size on, let's just say, in a $2,000 account, and price goes against you 25 pips and you're down $250 already, you're going to be panicking, freaking out. So just know that everything is a process and don't rush it. You will increase your lot size over time as your account balance starts to increase, and as your skill level starts to increase as well. Right, so let's just go back to this example. Now, USD JPY is trading at the current exchange rate of 1.19 or 119.80, right? And at a 0.01 at the current exchange rate, 119.80, at 100,000 unit standard lot size, that's going to be making us $8.43 per pip. Now, again, depending on what you're trading, the value of the lot size changes. The lowest it'll be is $8.43. The highest it'll be is probably $10, right? But it's around an average. So this is going to be 1 pip. This is going to be the exchange rate. Your lot size is here. This is how much you're making per lot. So all you have to do is all this does is simply calculates the value of the pip. Now, if you notice, a 0.01 has 2 decimal places, right? Now, if you ask yourself why, that's because you're trading the yen. Typically, when you trade the yen, it has 3 decimal places because all brokers offer the pipette, so it'll be worth $10 per pip. Now, let's look at another example without the JPY. Let's assume you're using 1 lots on USD CHF, which is another one of those pairs, right? Another one of those slower moving pairs, right? So we have a 1.4555 being the exchange rate. Now we add that extra decimal place. That's going to be $6.87 per pip, right? So you can also think about it this way: the more popular the pair is, being one of the major pairs, the more value that lot size is going to cost you, or that lot size is going to hold, because there's more volume in the market, right? So that has 4 decimal places. Now again, don't worry. You don't have to sit there and do the math for every single trade. The broker does all the calculations for you. In terms of stop loss placements, take profit placements, and everything else. I just wanted you to understand the math and principle behind all of this. Now, what is the bid price? The bid is the price at which the market is prepared to buy a specific currency pair in the Forex market. At this price, the trader can sell the base currency. So the broker is going to offer you a bid and an ask price. Those are the prices you're going to actually get in at. So let's just say gold is trading at 1,800, right? The broker may, if you want to sell gold, the broker may actually put the bid price not at 1,800, but at 1,801, right? And that 10 pip difference is going to be the spread. The spread is the difference between the bid and the ask price. That's another way that the brokerage makes their money, right? Which, depending on the brokerage, they might have bigger spreads or they might have lower spreads. There's lots of different account types and account sizes. But typically you want to use a brokerage that has a little bit higher commission, meaning they charge you $7 per lot size, let's just say, which is pretty average, or it's pretty low. But the spread is a lot smaller, right? Now, this is going to be the bid price. The bid price is going to depend on the base currency, and then we have the pip value here. So notice how this is a 2 pip difference, right? So the ask offer price is the price at which the market is prepared to sell a specific currency in the Forex market. At this price, you can buy the base currency, right? So here's the ask price, and then notice a bid. Now the bid ask spread. This is the bid ask price that I was telling you about, this is where the brokerage makes their money, right? So notice how the spread is the difference between the bid and the ask price. So this is the bid price, 1.1051. This is the ask price, 1.1053. Right now, again, look at the pip. Look at the last value here of the decimal place. 1 and 3. Notice how there's a 2 number difference. If we take 3, subtract it by 1, we're going to have 2. This means our actual spread is going to be 2 pips. So the broker is going to put us at a 2 pip difference when we actually take the trade, and this is how they make their money. Now, what is a quote conversion? The exchange rates in the forex market are expressed using the following format: base currency, quote currency, and then the bid and ask price. Now, what is a transaction cost, right? This is going to be the spread. This is where the broker makes their money again. In the case of Euro USD being at the exchange rate of 1.2812 and 1.2815, the transaction cost is 3 pips. The transaction cost is the spread, which equals the ask price minus the bid price. Now, what is a cross currency, right? Pretty simple. Again, that's just how the brokerage makes their money, all throughout spread. What is a cross currency? A cross currency is any currency pair in which neither the currency is the US dollar. Usually cross currency pairs carry a higher transaction cost. What they mean by this, or what I mean by this, is pretty much that if you're not trading one of the popular pairs that offer the US dollar, then they're going to have a higher spread and a higher commission because there's less volume traded within that currency pair. Now, typically in Forex, the more popular a currency pair is to trade, the more manipulated that currency pair is going to be. And of course, big banks, hedge funds, institutions manipulate price sometimes to make extra money. It's like a here and there type of thing where they do price manipulations, right? And, it's not something that you really have to be worried about, but just know once in a while, if you ever get taken out of the trade early and then you see price move in your favor, that's simply because market has been manipulated to hit the majority of the stop losses that we place. And then the institutions take price in the favor that price was normally going to go. And this is how they make, another way they make their money. So if you tend to trade less popular pairs that don't involve the US dollar, then, you're going to find there's going to be less manipulation. And once again, don't try and memorize everything. A good rule of thumb is just to simply make sure you understand the basic idea of how all these terms work together. It's literally as simple as that. Like I said previously, I don't want you guys to just overcomplicate things. As time goes on, you will understand these concepts better and better, and actually applying them to the chart, like learning how much the market is moving, how much the market has moved yesterday. Let's just say yesterday the market moved 100 pips, and you're expecting another 100 pip move today. Again, everything is trading, and everything is experience in trading. And one thing I've always told my students is that any trader that actually stays to it and will only, I don't know why I'm getting like whatever. Point is, right, what I was going to say is the only traders that fail are the ones that quit. So just stay to it. Don't give up. Again, this is just the beginning section of things, right? Things will start getting a lot more simpler as time goes on. You actually become a more experienced trader. And that's really all we wanted to cover today. Again, in the next section, I'll show you everything else on how to calculate pips and your lot sizes and how to enter your lot sizes and everything else. So talk to you guys in the next section.